excerpts from my work, Impact of Disentangled Oil Shocks on the Indian Sectoral Returns, Dynamic Connectedness and Spillovers. So moving on to the background, there exists a rich literature on the oil price stock market nexus, oil being the lifeblood of the industry and the economy alike. It's very important to study the impact of oil price pass-through to the stock markets, which is a major financial indicators which shows the economic performance. And there are several channels of operation. Two major channels of operation of the pass-through are the production channel and the consumption channel. Coming to the production channel, whenever there is an increase in oil price, it increases the cost of production and pushes down the profits, as a result of which the stocks become less attractive. Similarly, in the consumption channel, whenever there is an increase in oil price, there is a chance of inflation, and the inflation increases the interest rates. As the increase in interest rate happens, the investment becomes less lucrative and the overall investment goes down along with the output and employment. So the interaction between the oil price and the stock market is very strong. And recently we have been experiencing exceedingly fluctuating crude oil prices. So it has been around $20 in 1980s and reached its highest in 2008, just to plunge to the lowest in 2009, and again flipping to a negative range in 2020. So the global crude oil price is exceedingly fluctuating in the recent past, and the impact of the oil price on the stock markets has been increasing due to the increasing global financial integration and the inimical information pass-through, which leads to the contagion effect in the stock markets across the globe. It also results in recurring irrational speculative bubbles, mainly due to the influx of more number of irrational or noise traders. And coming to the context of India, we see that India is the third largest oil consumer and it imports 80% of its oil needs. And its oil import bill is almost one third of its total import bill. And also, since it has a nascent equity market, it makes the stock market of India more susceptible to the oil price shocks. Coming to the literature review, there exists an extensive literature on the oil stock nexus. These are the seminal works starting from Benank 1983. So there are many seminal works. Also, different sets of studies have yielded different results. There are few studies that show significant positive impact relationship between the oil price and the stock markets. Few studies show significant and negative impact, and there are few studies that have mixed results. So this is perplexing actually, why the oil price is causing different sort of relation between the across the stock markets. So in 2009, Killian devised a methodology to disaggregate the whole oil price shock into three, that is oil supply shocks, demand shocks, and the oil specific shocks, following which many economists have tried to study the impact of segregated oil price shocks on the stock markets. In this study, we adopt the daily frequency decomposition given by Reddy 2018. And this is the motivation for the current study. We see that most of the literature is dominated by the studies made in the developed markets, and we observe scanty literature pertaining to the emerging market economies, when emerging market economies actually bear the brunt of high oil prices due to exceeding demand for oil in these countries. Also, we observe a dearth of sectoral level analysis. When we use aggregate index, actually the heterogeneity that exists among the industries are masked. So there needs to be sectoral level studies. Also, we experience the absence of connectedness studies that study the connectedness between these sectors. So in our work, we try to, in the Indian context, to make a daily frequency analysis across different time horizons over a period of time, taking the 3 oil price shocks and the 12 Indian sectors. Also, we study the change in spillover patterns during periods of extreme turmoil. These are the variables of interest. For supply shocks, we take the returns of NYMEX light sweet crude oil 1 month futures And for the demand shocks, we take returns of NYSE Arca Oil Index. It's an index of the oil producing companies. We follow the assumption that the changes in the valuation of the oil price, oil producing companies' stocks indicate the change in global demand for oil. And third, risk shocks, which are taken as the innovations to CBOE volatility index. And sectoral returns are the log transformed returns of the sectoral prices. Coming to the methodology, we follow a two-step approach. The first is the structural VAR. We use a structural VAR methodology to extract the oil shocks and make them observable variables. So the matrix A maps the identified shocks into observable variables so that that can be used for further analysis. And the orthogonality of the shocks is defined as this matrix A, and it's very important. And once we obtain the three oil shocks, the oil supply shock, demand shock, and the risk shocks, we take these three shocks and the 12 sectoral returns and go for a time frequency analysis. So we follow the time frequency approach given by Barunik and Kralik 2018, which is an extension of the Diebold and Yilmaz 2012 and 14. So the advantage of the methodology is that it accounts for the frequencies of responses rather than the impulse response function alone. Also, it follows the identification given by Pesharan and Shin 1998. It also gives the generalized forecast error variance decomposition of a variable into components attributable to the shocks to different variables in the system. So basically, it tries to extract the components of the shocks to one variable that helps in explaining the variations in the other variables in the system. So the total connectedness in the system is given by this, and we also calculate the within, to, and from spillovers. So this is the summary statistics. We have the three shocks and the 12 sectors. We observe that IT sector has the highest mean and telecom the lowest. And among the shocks, demand shocks has the highest mean and the risk shock the lowest. Standard deviation is highest for metals, followed by telecom and finance, and FMCG and health are the sectors that are least fluctuating. Now we go on constructing the spillover indexes in the three time horizons, the short term, medium term, and the long term. The short term period is 1 to 5 days, which is a stock market trading week. And the medium term is 5 to 22 days, which is 1 month in the stock market. And the long term is above 22 days to infinite days. So here we have the static connectedness in the short term. We observe that the total connectedness is 60.08%, which means that 60.08% of the variations in a variable is explained by the variations in other variables in the system. So in the short term, it is 60.08%, which is high. And coming to the medium term, it becomes 12.11%, and in the long term, it is 4.39%. So we observe that the spillovers are highest in the short term or the higher frequency. So this is a summary of the net spillovers in the three horizons. So we have the sectors and the shocks. The ones in greens are the net transmitters of spillovers, and the ones in red are the net receiver of spillovers. So we observe that these sectors such as FMCG, health, IT, and telecom are the sectors which are consistently net recipient of spillovers across all the three time horizons. And among the shocks, supply shock is the net recipient across all the three time horizons. Demand shocks and risk shocks are more or less net transmitters of the spillovers. Now, this is a detailed analysis of the reception of the spillovers among the sectors and the shocks. Among the sectors, the highest reception of spillovers is for basic materials and finance in the short term, while consumer discretionary items and industrials join the league in the medium and the long term. We observe that the least reception is for health, IT, telecom, and fast-moving consumer goods. Among the oil shocks, highest reception is for demand shocks, followed by the risk shocks across all the time horizons. Now coming to the spillover transmission, Among the sectors, basic materials, consumer discretionary items, and industrials are the topmost transmitters of spillovers across all the horizons, followed by power and metal sector, and the least transmission is attributable to IT, FMCG, and health. And among the oil shocks, demand and risk shocks are the major transmitters of spillovers among the shocks. Now, we were analyzing the static connectedness till now. Let's move on to the dynamic spillovers. It's important to see the evolving pattern of spillovers over a period of time. So we see that the spillovers are highest in the short term in the dynamic spillovers. We take a rolling window, and 85% is in the short term, while medium term accounts for 25% and long term 5%. Also, when we compare the global financial crisis of 2008 and the COVID-19 pandemic, we see that during the COVID-19 pandemic, there is a sudden spike in the spillovers, which recedes down fast. But in the case of global financial crisis, there is a sustained spike in spillovers during the period before and after the global financial crisis. And generally, we observe a tendency of these spillovers to spurt during periods of extreme turmoil. So we also try to see the individual contribution of each shocks to the system. So the supply shocks are given in the blue color, demand shocks green, and risk shocks yellow. So we see that in the short term, contribution to the overall spillovers is dominated by the supply shocks. And COVID-19 period witnesses more of risk shocks compared to the global financial crisis. In the global financial crisis period, we see more of supply shocks, and reduced supply and demand shocks are observed during COVID-19 period. Moving on to the contribution of shocks in the medium term and long term, it's more or less similar, with the demand shocks dominating the spillovers, and supply shocks are prominent during the global financial crisis, and demand shocks are more prominent during the COVID-19 pandemic. And in the overall time frame, we see that the demand shocks are more prominent in the Indian scenario.
So please take a minute.
Yes, sir. Then we go for a network analysis as a robustness. Here also we observe that basic materials, consumer discretionary items, and industrials remain the major net transmitters, and IT is the major spillover receiver. So the green nodes are the net transmitters and red ones are net recipients. And from the thickness of the edges and the strength of the spillovers can be identified. So in the short term, the connectedness is very high, while it is falling considerably in the medium and the long terms, as indicated by the thin lines connecting edges. So in order to as a conclusion, total connectedness is highest in the short term, while it falls drastically in the lower frequency bands. Among the oil shocks, oil demand shock is the major spillover transmitter across all the time horizons, followed by the risk shock. Oil supply shock is a net receiver in all the frequency bands, and among the sectors, basic materials and finance have the highest reception from the oil shocks in the short term, while consumer discretionary items and industrials join the list in the medium and long term. FMCG, health, telecom, and IT sectors have the least reception in all the bands, making them apt for investments during periods of extreme oil swings. Dynamic connectedness analysis also reveals that the spillovers have a tendency to shoot up during times of extreme oil price fluctuations, as we see in the case of GFC and COVID-19 pandemic. So we believe that the results will be of use to the investors in designing an optimal portfolio and the policymakers in taking prompt actions during periods of extreme oil swings. Thank you.